On Monday, a single share of a company is worth $200. By Friday, the exact same company, the same offices, the same employees, the same products, that share is worth $160. Nothing about the business physically changed, and yet, on paper, billions of dollars simply vanished. So where did that money go? Who decided the price should fall? And why do stock prices move up and down every single second the market is open? By the end of this video, you'll understand exactly what moves a stock price. Not with jargon, not with hype, but in plain, simple language. Welcome to Ticker Theory. Let's learn the market and learn to think independently. Here's the first idea that changes everything. A stock price is not a fact. It's an opinion. More precisely, it's the single most recent price at which one person agreed to sell a share and another person agreed to buy it. That's it. The price you see flashing on your screen isn't handed down by the company, and it isn't set by some official authority. It's simply the last handshake between a buyer and a seller. And because new buyers and new sellers are stepping forward every second, that last handshake keeps changing. So when you ask, why did the price move? You're really asking a simpler question. Why were people suddenly willing to pay more or accept less than they were a moment ago? Every price movement, no matter how complicated it looks, comes down to one timeless force: supply and demand. Demand is the crowd of people who want to buy a stock. Supply is the crowd of people willing to sell it. When more money wants to buy than wants to sell, buyers have to compete with each other. They offer higher and higher prices to win the limited shares available, and the price rises. When more people want to sell than buy, the opposite happens. Sellers compete to find someone, anyone, to take the shares off their hands, so they accept lower and lower prices, and the price falls. A stock market is really just a giant, never-ending auction. Understand that, and you understand 90% of price movement. Let's make that auction concrete. Imagine a single share of a company, and only one is for sale. 3 buyers want it. The first offers $100. The second, wanting it more, offers $102. The third jumps in at $105. The seller happily takes the highest bid, and just like that, the recorded price of that stock is $105. Now flip it. Imagine 3 people, all desperate to sell, and only one buyer in the room. That buyer holds the power. They offer $95, then $90, and a nervous seller accepts. The new price is $90. Same stock, same day. The price is decided entirely by who is more eager and who is more desperate. So if supply and demand set the price, the real question becomes, what makes thousands of people suddenly want to buy or rush to sell at the same time? This is where it gets interesting, because the answer is a mix of cold logic and hot emotion. There are 4 big engines that drive that decision: company performance, the wider economy, news and expectations about the future, and human psychology, fear and greed. Let's walk through each one, because once you can spot these forces in the wild, the market stops looking random and starts looking readable. The first engine is the company itself. When you buy a stock, you're buying a tiny slice of ownership in a real business. So the health of that business matters enormously. 4 times a year, public companies report their earnings, how much money they made, how fast they're growing, and what they expect next. If a company earns more than investors expected, demand surges, buyers pile in, and the price jumps. If it earns less or warns that tougher times are ahead, sellers rush for the exit, and the price drops, sometimes violently, within seconds of the report. This is why you'll often see a stock move 10 or 20% in a single day around earnings. The business didn't change overnight, but the crowd's opinion of its future just did. The second engine is the world the company lives in, the broader economy. Even a great business is affected by the tide around it. When interest rates rise, borrowing becomes more expensive, growth slows, and safer options like bonds suddenly look more attractive than risky stocks, so demand for stocks can cool and prices fall. When rates fall, money flows back toward stocks in search of higher returns, and prices tend to rise. Inflation, unemployment, consumer spending, even events on the other side of the planet, all of it shapes how confident investors feel. When people feel confident about the future, they buy. When they feel uncertain, they sell. The economy is the weather system every single stock has to fly through. Here's one of the most important and least understood truths about the market. Stock prices are not about the present. They're about the future. The market is a forecasting machine, constantly trying to price in what it thinks will happen next. This is why a company can announce record profits and its stock still falls, because investors expected even more. And it's why a struggling company's stock can soar on a single hopeful announcement. The famous phrase is buy the rumor, sell the news. By the time good news is official, the smart money already bought in anticipation, so the price often peaks exactly when the headline arrives. The market isn't reacting to today. It's placing bets on tomorrow. And now, the fourth engine, the one most beginners underestimate, and the one this channel cares about most: human emotion. Behind every buy and every sell is a person, and people are driven by two powerful feelings: fear and greed. When a stock is soaring and everyone is making money, greed takes over. People pile in, terrified of missing out, pushing the price far above what the business is actually worth. Then, something spooks the crowd. Fear takes the wheel, and the same people who bought in excitement now sell in panic, dragging the price far below fair value. This is why markets overshoot in both directions. The company moves in a straight line. The crowd's emotions swing like a pendulum. Learning to notice that pendulum, in the market and in yourself, is the single most valuable skill an investor can build. Let's tie all four forces together with a story. Picture a company called Brightleaf. For months, its stock climbs steadily as it reports strong earnings. That's force one, the business, doing its job. Then the central bank signals lower interest rates. Force two, the economy, adds fuel, and the climb accelerates. Excitement builds, headlines call it the next big thing. Force three, expectations, sends new buyers rushing in. And finally, greed takes over. Force four, as people who know nothing about the company buy simply because it's going up. The price is now far above what the business is worth. Then one ordinary earnings report comes in merely good instead of spectacular. Expectations were too high. Fear flips the pendulum. The crowd stampedes for the exit, and the price tumbles. Not because Brightleaf failed, but because the emotions that lifted it too high now drag it too low. Now you can see why a price flickers constantly during market hours. At any given moment, millions of people around the world are each weighing these four forces differently. One investor reads the earnings as a warning and sells. Another reads the same report as an opportunity and buys. Every trade updates that last handshake price tick by tick. Big institutions with billions of dollars can move a price in an instant. Tiny trades nudge it slightly. It's a live, global tug-of-war that never fully rests. So the next time you see a stock jiggling up and down, remember, you're not watching randomness. You're watching a real-time vote. Millions of opinions about the future colliding second by second. So what should you actually do with all this? 3 simple takeaways. First, short-term price moves are mostly noise, emotion and expectation swinging back and forth. Don't let a red day convince you a good company is doomed, and don't let a green streak convince you you're a genius. Second, over the long run, prices tend to follow the real thing, the actual earnings and growth of the business. Emotion rules the days and weeks, fundamentals rule the years. And third, your biggest advantage isn't predicting the crowd, it's staying calm when the crowd isn't. The investor who understands why prices move is far less likely to panic sell at the bottom or greed buy at the top. Knowledge is what turns the market from something scary into something you can navigate. Let's lock it in. A stock price is simply the last agreed handshake between a buyer and a seller. It moves because of supply and demand, who's more eager and who's more desperate. And that eagerness is driven by four forces: the company's performance, the wider economy, expectations about the future, and the raw emotions of fear and greed. Short term, emotion dominates and prices overshoot. Long term, the real business is what matters. Master those ideas, and the market's daily chaos suddenly has a logic you can follow. If this made the market a little clearer, that's exactly what ticker theory is here for. No hype, no stock tips, no fear. Just the market, explained simply, so you can think independently. If you found this useful, subscribe and hit the bell, because in the next video, we answer the natural next question. What is an index fund, and why do so many experienced investors put their money there? It's one of the most powerful ideas in all of investing, and it's simpler than you think. I'll see you in that one. Until then, learn the market and think for yourself.